Good morning. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Efficient Market Advisors. We are a business of Cantor Fitzgerald Investment Advisors. This is our weekly market and economic commentary for the week beginning Monday, April 16th, 2018. The presentation you are about to see and or hear is either developed by EMA or obtained from sources that we believe to be reliable. We expect each investor and financial advisor to make their own investment decisions. Nothing contained in this presentation should be treated as investment advice or a recommendation for the purchase or sale of any security. Let's begin. We had a great week, a nice strong rebound in equity prices last week as we moved closer into the bulk of earnings season. We began to get some earnings of bank companies, which were mostly better than expected last week. Despite that, though, financial stocks led by the big banks sold off on Friday on some worse than expected guidance. Nonetheless, markets were strong in total for the week. S&P 500 now just about back to break even. Small cap stocks are positive along with international markets. Yields were slightly higher, sending the aggregate bond index and the 20-year Treasury index both slightly lower for the week. High yield, in a sign that the economy remains strong, continued to see the spread, that's the difference in yield between high yield bonds and U.S. Treasuries, narrow. High yield returned almost 1% on the week. Also, commodities really picked up. Stronger economic activity and a little bit on U.S. inflation and a weaker dollar. We saw the Bloomberg Commodity Index rise almost 2.7% on the week. And as it's Monday morning on the 16th, I'm seeing some of that carry forward into this week. The HFR Hedge Fund Index for the week ended Thursday, up about 0.25%. So let's get into some of the kind of interesting data. I found this chart on the WSJ Wall Street Journal Daily Shot Report. I thought it was really interesting. Apparently, Bank of America puts out something called a wage proxy, which is based on anonymous aggregated payroll direct deposit from their customers. And what you see here is a pretty significant pickup in payroll direct deposit activity. Now that's 7.5% year over year. Part of that is due to the tax cut and lower withholding rates, so we would expect that. But it also is a sign that the job market has continued to expand. More people are getting payroll, and it certainly bodes well for the rest of 2018. It's one of the reasons we at EMA were not and are not sort of dissuaded because of some of the volatility we've seen lately. We continue to look at a lot of underlying gauges that suggest that 2018 will be a great economic and profit year. Speaking back to commodities for a second, oil continues to rise and has broken out of a long sideways trend that started in 2015 after the big drop. And gold, another commodity, a precious metal commodity, starting to trend higher and is getting close to breaking out above its previous high. Here you can see at about 1350 right here. And we're getting close to breaking out above that. Well, we own the BCI, Bloomberg Commodity Index ETF. It's an ETF that tracks the Bloomberg Commodity Index, and it contains, of course, oil futures contracts along with other commodities and gold futures contracts. Speaking of high yield and how well it's done, earlier in the year, a lot of folks are talking about these spreads to treasuries, which are very low by historic standards. They've come down significantly from, there were some concerns up here in 2015. A lot of folks thought that spreads on high yield were going to widen this year as the economy perhaps slowed. That has so far not been the case. In fact, those spreads tightened further last week. We've got good returns so far on high yield. In terms of economic data last week, the NFIB, National Federation of Independent Businesses, puts out a small business optimism index for the month of March. It fell slightly, but to a very high reading, still of 104.7. Wholesale inventories continue to rise, up 1%. That's on top of a 0.9% gain in January. And so when you see inventories rise, you wonder, is that a problem that they're not pushing through the inventories to the other end? but it does not seem to be the case because sales continue to trend higher as well. Now, I think much of 2018, as I've said in the past, will be determined on what happens with price levels, i.e., inflation. Now, the producer price index, the consumer price index, were both released last week for March. And in March, the PPI rose 0.3%, is 3% higher than it was a year ago. The core PPI, that removes food and energy, that's the red line on your screen, is up 2.7% year over year. There was a pickup in prices related to some steel and aluminum tariffs that were enacted just recently. Now, the Fed has a mandate from Congress, and that is to maintain price stability. Price stability the Fed defines it themselves as 2% inflation. They don't measure that with the core PPI. They do measure it with something called core PCE. Still, these numbers getting close to 3% are suggestive of further interest rate hikes. Regular initial claims for unemployment down 9,000 on the week to 233, continue to be at or near recovery lows. 4-week moving average is up slightly. This continues to be a sign that the April jobs report will be pretty solid. Also, job openings. Later in the week, we got the JOLTS report. It fell a little bit to 6.05 million, but still at a very, very high level. The gap between openings and hirings has widened a bit, which continues to suggest that the economy is at full employment and suggests upward pressure on wages, which of course is upward pressure on inflation readings. University of Michigan released their Consumer Sentiment Index for April, and it fell slightly to 97.8. Expectations dropped a little bit. Perhaps that's due to market volatility. Perhaps it's due to some of the domestic political happenings here, but regardless, still at a reasonably high level. In terms of economic data for this week, we will get retail sales, New York State manufacturing, business inventories, and National Association of Home Builders Sentiment Index all on Monday. Tuesday, housing starts, industrial production. Wednesday, the Fed puts out its beige book. That's essentially the board book for the FOMC for their upcoming policy meeting. Thursday, jobless claims and Philly Fed survey. Friday, nothing scheduled. I expect this week's market action not to be driven so much by these economic data, but by corporate earnings, announcements, and guidance this week, as well as geopolitical events surrounding both Syria, Russia, and of course the Trump administration's ongoing workings with the Mueller investigation. All of those could have impact on the market this week. As always, thanks for tuning in. We'll talk to you again next week.